This video is created by Jagrat Creation. It is on amalgamation of partnership firm. I wish to solve one sum here before you. Observe the sum on the screen. This is the sum which I wish to solve here before you. You can pause the video and read the sum carefully. The balance sheet of two firms, Akar and Bakar and Manav and Danav, as on 31st of March 2017 are as follows. So you are given the balance sheet of two partnership firms. In the first firm, Akar and Bakar are the partners. In the second firm, Manav and Danav are the partners. These are the assets and these are the liabilities. Akar and Bakar shared profits in the ratio of 3:2. Manav and Danav shared profits in the ratio of 5:3. The two firms decided to amalgamate, and the new profit sharing ratio amongst Akar, Bakar, Manav and Danav is 3:2:3:2. The other terms are as follows. Goodwill of Akar and Bakar will be valued at 40,000, that of Manav and Danav 30,000. The new firm not to retain goodwill in the books. So in the new partnership firm, after purchase of goodwill, goodwill is required to be written off. The stock of Manav and Danav was valued at 53,500. Building was valued at 40,000. The reserve of 5% on debtors necessary for bad debts in both the firms. The plant and machinery of Messrs. Manav and Danav not taken over by the new firm, and Manav agreed to take over for 18,000. Outstanding rent of both the firms should be discharged by the respective firm. So outstanding rent. So rent outstanding 3,000 and 2,000 will be paid by the firm itself, and after that the partnership firm is transferred to a new firm. The total capital of the firm was fixed to be 1,60,000 to be contributed by the partners in the new profit sharing ratio, that is 3:2:3:2, and the necessary adjustment rate to be made in cash. Prepare realization accounts. The similar sum I have solved here before you, wherein I have solved the sum by preparing revaluation account. The same sum I am going to solve here before you by preparing realization account. That is the most important point. So prepare realization account of the partners' capital accounts in the books of old firm, and amalgamation and amalgamated and the balance sheet of in the books of new firm. Now see. Here the partnership firm Akar and Bakar is dissolved. When the partnership firm is dissolved, all the assets and liabilities are realized. The realized value of assets and liabilities are to be compared with the book values, and the profit or loss on realization of assets and liabilities is being found out. Similarly, here the partnership firm of Manav and Danav is also dissolved. All the assets and liabilities of Manav and Danav are realized. Profit or loss on realization is distributed amongst Manav and Danav. Now, what is the most important point? The partnership firm and Akar and Bakar is sold to a new firm, wherein Akar and Bakar are going to be partner. The partnership firm of Manav and Danav is sold to a new firm, where Manav and Danav are also going to be the partners in the new firm. So in the new partnership firm, there will be four partners, Akar, Bakar, Manav and Danav. So it's an amalgamation of firms. But the accounting for amalgamation of firms is being done in a manner that the partnership firm of Akar and Bakar is dissolved, partnership firm of Manav and Danav is dissolved, and both the dissolved partnership firm sell their business to a new firm wherein they are the partners. This is the understanding with which this sum is to be solved. Now, for the purpose of solving the sum, by preparing realization account, we should first of all find out the sales price of the business for the vendor firm, or it is same as purchase price of the business for a new firm. So first of all, we are required to find out the purchase consideration for the transfer of existing firm of Akar and Bakar to a new firm. What is the purchase consideration value for the firm of Manav and Danav when the firm of Manav and Danav is transferred to the new firm? So first of all, we are required to find out the purchase consideration statement. Purchase consideration statement decides the price at which the exchange of business has taken place. So for vendor, it is a sales price. For a purchaser, it is a purchase price, and that is identified as purchase consideration. So for the purpose of this sum, first of all, I would like to find out the purchase consideration for the firm of Akar and Vakar, I would like to find out the purchase consideration for the firm of Manav and Danav. So I am going to find out the purchase price of Akar and Vakar firm and Manav and Danav firm for the new firm, and it is also identified as sales price for Akar and Vakar, Manav and Danav. Let us start. So here I want to find out the purchase consideration. Now, whenever this is the details, or this is the balance sheet given to me, so this is the details given to me in the sum. Now, first point. Assets purchased, liabilities taken. The assets are purchased, liabilities are taken. From the assets value, liabilities purchased will be deducted. So, we will find out the value of net assets purchased. So, price at which the net assets sold by Akar and Vakar, price at which the net assets are sold by Manav and Danav. That we want to find out first of all. Now, goodwill of Akar and Vakar was valued at 40,000 and that of Manav and Danav 30,000. So, new partnership firm has purchased the business of Akar Vakar and Manav Danav. At that time, new partnership firm has agreed to pay for goodwill. That's for Akar and Vakar 40,000. That for Manav and Danav 30,000. So, goodwill is purchased by a new firm at this price. Next, stock of Manav and Danav valued at 53,500. So stock is 52,000, but it is purchased at a price of 53,500. So this stock is purchased at 53,500 implies that the stock of Akar and Vakar is purchased at book value. That is the important understanding that the student should hold. So stock of Akar and Vakar purchased for 20,000 and stock of Manav and Danav is purchased at 53,500. This is how it should be interpreted. Now, building was valued at 40,000. Now, who holds building? Akar and Vakar has building. Manav and Danav is not having any building. So, this 30,000 is valued at 40,000 and this building is purchased by the new firm at a price of 40,000. So, building purchased at 45,000. Here, there is no building. Notice it. Now, reserve of 5% on debtors was necessary as bad debts. So, what are the debtors? 10,000, 30,000. 5% bad debt reserve is required to be deducted, that I will deduct along with liabilities. So, 10,000 into 5%, 500 bad debt reserve deducted. Similarly, 30,000 into 5%, 1,500 bad debt reserve deducted from debtors and it is deducted along with liabilities. Plant and machinery of Manav and Danav was not taken over by the new firm, which Mr. Manav agreed to take for 18,000. So this plant and machinery of Manav and Danav is not purchased. That's an important point. But the plant and machinery of Akar and Vakar is presumed to have been purchased at book value. So plant and machinery of Akar and Vakar purchased at 40,000. Plant and machinery of Manav and Danav is not purchased. Implies that it goes without saying when the business is purchased, all the assets and liabilities are purchased, except those are specifically identified not to have been purchased. Now, outstanding rent of both the firm should be discharged by the respective firm. So, rent is 3,000, cash balance is 5,000. So, out of 5,000, rent will be paid and the balance cash will be purchased along with all the assets of the business being purchased. So, here 5,000, 3,000 is the rent outstanding, 5,000 is the cash balance. So, from cash balance 3,000 is deducted. So, cash balance purchased, that value cash balance purchased is of 2,000. Similarly, here 2,000 is the rent paid from cash balance of 14,000, 14,000 minus 2,000, cash balance purchased 12,000. This is how assets are purchased. So, all the assets are purchased. Now, what are the remaining assets? Investments are purchased, that of Manav and Danav. So, building, plant and machinery, stock, debtors, cash, everything is taken care of. Look at the liability side. On the liability side, bills payable of Manav and Danav is purchased for 30,000 and creditors of Akar Vakar and Manav and Danav purchased for 20,000 and 16,000. This is how assets and liabilities are purchased. From the total of assets, liabilities are deducted, you will get the net assets, that is the sales price of a business for a vendor firm, and it is same as purchase price of a business for a purchasing firm. So now you are required to find out the total of assets. Total of assets for like 45,500 minus 20,500 and 47,500. So this is the purchase price. This is the price at which the business is purchased, or this is the price at which the business is sold. Now after preparing this purchase consideration, let me first of all write down the books of accounts of a vendor firm. So I want to prepare the dissolution accounting in the books of Vakar and Vakar. For that I am going to prepare realization account, partner's capital account, and the new firm to whom the business is being sold. So let me start preparation, the ledger accounts in the books of Vakar and Vakar. So here I prepare realization account, new firm account to whom the business is sold, and the partner's capital account. Now first step for the purpose of solving the sum, all the assets and liabilities to be realized are transferred to the debit side of realization account. So here, copy the balance sheet. So all the assets are transferred to the realization account. Building debited to realization account, plant and machinery, stock, debtors, investments are not there. On the liability side, you have to transfer creditors. This cash balance is transferred, 5,000 minus 3,000, 2,000 cash balance is transferred. Now creditors are transferred to the credit side of realization account. Bills payable are not there. Outstanding rent is already paid from the cash balance. Now this is how assets and liabilities are transferred. Now next point. Vakar and Vakar share the profits and losses in the ratio of 3:2. So general reserve 12,000 will be distributed amongst partners in the ratio of 3:2. It is an undistributed profit, and this undistributed profit is distributed amongst partners in their profit sharing ratio at the time of dissolution. So 12,000 distributed in the ratio of 3:2. So 12,000 into 3 by 5, 12,000 into 2 by 5. So 24 twos and 24 threes. This is how general reserve is distributed. Capital balances are recorded as balance brought down in the capital account of Vakar and Vakar. This is how all the balance sheets details are considered. Assets transferred to realization account, liabilities transferred to realization account, general reserve distributed, capital balances recorded in the capital account. Next. Now all these assets and liabilities are sold at a price of 1,31,500. So write the entry for sales consideration for the business due. So sales consideration, that is 1,31,500, that is a purchase price for the purchasing firm. So this is a sales value. This sales value is due from the new firm. New firm is the receiver of the business. New firm is the receiver of net assets. New firm is the receiver of assets and liabilities. Debit the receiver. So new firm account debit to realization account credit. After that, find out the profit or loss on realization account. Total of credit side minus total of debit side, you will get the profit of realization account. This realization profit should be distributed in the ratio of 3:2 amongst partners. So 49,500 distributed in the ratio of 3/5 of 49,500. 3 by 5 of 49,500, that works out to be 29,700. And 2/5 of 49,500, that goes to Vakar's capital account. So realization account debit to partner's capital account credit. So this is the amount transferred to partner's capital account. Now this is the sales price of the business. Now sales price is to be realized from the new firm, but in this sum it is an amalgamation of partnership firm. The claim of partners, the partners' claim at the time of dissolution of a partnership firm will be transferred to the new firm because they are going to be the partners in the new firm. So capital balance I want to find out. This capital balance of Vakar and Vakar will be transferred to the new firm. So their claim in the old firm on dissolution of a partnership firm is transferred as their claim in the new firm. So when their claim is transferred in the new firm, they acquire a status either of a creditor or of a partner in the new firm. Here in this sum, they are going to acquire a status of a partner. So they are going to be the partners in the new firm. Vakar and Vakar are going to be partner in a new firm wherein there will be 4 partners, Vakar, Vakar, Manav and Danav. So these capital balances are transferred to the new firm. The new firm account will tally. So now nothing is recoverable from new firm because new firm has committed to pay Vakar and Vakar this much amount. That is their capital due in the case of dissolved firm. This is how I have prepared the ledger accounts of Vakar and Vakar, wherein realization account, new firm account and partner's capital account is prepared. Now I want to prepare the similar accounts for Manav and Danav. Let me start. So here I prepare realization account, new firm account and partners capital account in the books of Manav and Danav. All the assets and liabilities are to be transferred to realization account. Let me start with that. So, plant and machinery debited to realization account, stock debited to realization account, debtors debited to realization account, cash balance 14,000, from that outstanding rent will be paid and the balance cash will be transferred to realization account, because when the business is sold, business is made of all assets and liabilities. So all assets and liabilities are sold, so cash balance is also sold. So 14,000 minus 2,000, this is the cash balance that is being sold. Investment 20,000, book value transferred to the debit side of realization account. Now creditors credited to realization account, bills payable credited to realization account, outstanding rent is already paid. This journalism will be distributed in the ratio of profit sharing, that is 5:3. So 8,000, 5,000 and 3,000 credited to the capital account of Manav and Danav. Capital balance will be recorded as the balance in capital account. Balance brought down 60,000 and 20,000. This is how the details of balance sheet are recorded. Now this is the sales price. The sales price is due from new firm. All the assets and liabilities are transferred to the new firm. Net assets are transferred to the new firm. New firm is the receiver. Debit the receiver. And the realized value of assets are to be credited to realization account. So here, the new firm will be debited 98,000 and the realization account is credited. One more point in this sum, that all the assets and liabilities are transferred to the plant and machinery 20,000. The plant and machinery of Mrs. Manav and Danav is not taken over by the new firm, which Mr. Manav agreed to take over at 18,000. So Manav has taken the plant and machinery for 18,000. So Manav's capital account debit to realization account credit 18,000. Now as I told to you, this 98,000 is a sales price due from new firm account debit to realization account credit. So all the assets and liabilities are transferred to the new firm except plant and machinery, which is taken by Manav. So Manav's capital account is debited for plant and machinery, and for other assets, new firm account is debited and the realization account is credited. Now find out the profit or loss of realization account. That will be distributed between Manav and Danav in the ratio of 5:3. So your realization profit is 28,000 distributed between Manav and Danav in the ratio of 5:3. So 28,000 into 5 by 8, 17,500. 28,000 into 3 by 8, 10,500. This is a realization profit. Realization account debit to partners capital account credit. Now as I told to you, this Manav and Danav, the partnership firm of Manav and Danav is dissolved. They are entitled to have this much of claim from the assets of old firm. All the assets of old firm are transferred to the new firm. So their claim is also transferred to the new firm because they are going to be the partners in the new firm. So this capital balance of Manav and Danav is transferred to a new firm. So 64,000 and 33,500 is transferred to the new firm. So their claim in old firm is transferred to the new firm. And in new firm, they will get or they will recognize or this claim will be identified as capital in the new firm. That's an important point. And this is how new firm account gets closed. So this is how the realization account and the closing ledger accounts is prepared in the books of Manav and Danav. Now I want to record the journal entry and the balance sheet, etc. in the books of new firm. The new firm wherein there are 4 partners. Akar, Vakar, Manav and Danav, 4 partners are there. Now I am going to write down the books of accounts in which the business is purchased by the new firm. Those entries I want to record it. They will be recorded on the basis of this purchase consideration statement. So this is the assets and liabilities are purchased. So here I write down the journal entries. Business purchase account debit to Mrs. Akar and Vakar account credit. This is a partnership firm to whom the amount is payable. The business purchase price is payable. Now what is purchased in business? In business, building is purchased, building account debit, plant and machinery account debit, then stock account debit, debtors account debit, cash account debit, goodwill account debit, to creditors account credit, to bad debt reserve account credit, to business purchase account credit. So this is how 1,31,500 is made of this assets and liabilities. All the assets purchased are debited, all liabilities and reserves purchased are credited, and the net is the purchase price. So purchase price account that was debited, that got credited. So this business purchase account gets closed. Now this 1,31,000 is bifurcated in these 2 claims that I have explained to you while preparing the ledger accounts of Akar and Vakar. So this 1,31,500 That is the amount payable for the purchase of business. And this amount payable will be credited to the capital accounts of the partners who are going to be the partners in the new firm. So, here, Mr. Sakar and Vakar account debit 1,31,500. Amount credited to Akar's capital account. Amount credited to Vakar's capital account. So, this is how their claim in the old firm is identified as capital balance in the new firm. Now, I want to start the entries for the Manav and Danav. Business of Manav and Danav is purchased for 98,000. So, business purchase account debit to Messrs. Manav and Danav account credit. This 98,000 is made of this much of assets and liabilities. Assets purchase will be debited, liabilities purchase will be credited. Net amount is the purchase price that will be credited to business purchase account. So here once again, investment account debit, stock account debit, debtors account debit, cash account debit 12,000, goodwill account debit, to bills payable, to creditors, to bad debt reserve, to business purchase account. So 98,000 business is purchased and 98,000 is payable to the vendor firm, that is Messrs. Manav and Danav. The amount payable to Manav and Danav is bifurcated in this manner and they are going to be credited as a capital in the new firm. So here Messrs. Manav and Danav account debit to Manav's capital account debit to Danav's capital account credit. So their claims are converted into capital in the new firm. Now they have become the partners in the new firm. So this is how business purchase entries are recorded in the books of purchaser. Now I want to write down few adjustment entries. One, goodwill is required to be written off 1. And second, the partners have decided to maintain a minimum capital balance in the new firm. In light of that, they are required to bring cash or withdraw cash against their capital that has been recorded so far. Now let us start with that. Now, the two firms decided to amalgamate and the new profit sharing ratio is given. The total capital of the new firm is fixed at 1,60,000 to be contributed by the partners in the new profit sharing ratio, and the necessary adjustments are to be made. Now I am required to find out the shortage and excess. So this is the capital balance in the new firm. Now this goodwill is required to be written off as you are told to write off the goodwill. So 70,000 goodwill is required to be written off in the new profit sharing ratio. That is 3:2:3:2. So 70,000 distributed in the ratio of 3:2:3:2. So it is 10. So 10 divided by 70,000, 7 threes are 21,000, 24,000, 21,000, 24,000. This is the goodwill written off. When you write off the goodwill, the capital balance goes down. So this is the balance of capital account after goodwill being written off. Now partners have decided to keep the capital of 1,60,000 in the new profit sharing ratio. The capital required for Akar is 1,60,000 into 3 by 10. This is the required capital of Akar. Capital required for Vakar is 1,60,000 into 2 by 10. Capital required for Manav 1,60,000 into 3 by 10. And Danav, this is the capital required. So this is the required capital. Capital of Akar is 55,900. Capital required as per agreement is 48,000. So his capital is more than required. So he gets the refund. Here the capital existing 40,600. Capital required to be maintained 32,000. So excess capital will be refunded. Here the capital existing is 43,500. Capital required to be maintained 48,000. So Manav has to bring cash. Here the capital required to be maintained 32,000. Capital existing at 19,500. So Danav is also required to bring cash. So here the amount refunded to Akar 7,900. Refunded to Vakar 8,600. Shortage brought by Manav 4,500. Shortage brought by Danav 12,500. So I want to write down the journal entry for all these things. So Akar's capital account debit, Vakar's capital account debit, Manav's capital account debit, Danav's capital account debit to goodwill account, goodwill written off. This is the amount brought. So bank account debit 17,000 to Manav's capital account, to Danav's capital account, and amount redeemed to Akar and Vakar. So Akar's capital account debit 7,900, Vakar's capital account debit 8,600 to bank account 16,500. So first of all, I have written the journal entries. 3 to 6 journal entries for purchase of business. Then I wrote the entry for goodwill being written off. and these are the entries recorded for adjustment of capital as agreed, and for that cash is brought or cash is withdrawn to maintain the capital in the profit sharing ratio. Now after doing all these things, I would like to prepare the balance sheet. In the balance sheet, I will write all the assets by totaling in my balance sheet. Investment, then I write building, then plant and machinery purchased for 40,000, then total of stock, total of debtors I write in the inner column. From that, bad debt reserve is going to be deducted. So these are the net debtors reported in the balance sheet. After that, cash balance 14,000. That I write in the inner column, because here the cash brought is there, that is will be added, cash paid will be deducted. So Manav brought 4,500, 12,500 brought by Danav, paid to Akar and Vakar, that is deducted. So this is the net cash balance. Then comes bills payable on the liability side. Total of creditors will appear on the balance sheet liability side. Bad debt is already recorded. Now capital balance is to be recorded as required to be maintained. Akar 48,000, Vakar 32,000, Manav 48,000, Danav. This is the capital required to be maintained. They maintain the capital in the profit sharing ratio, and the total 1,60,000 as it is agreed by the partners to be maintained in the new firm. Now after recording capital and all assets and liabilities, I should make a total of the balance sheet. So total of asset side 2,26,000. Total of liability side is also 2,26,000. 6 plus 3, 9 plus 3, 12. 2,26,000. This is how balance sheet is prepared. So this is a sum wherein books of both ledger accounts in the books of both vendor firm, balance sheet and the journal entries in the purchasing firm is being recorded and explained. Once again I tell you, I have solved this sum by a different method, and that sum is already uploaded. Now I upload the same sum wherein it is solved by preparing realization account. Formally the same sum was solved by preparing revaluation account. That's an important point to be noticed by the students. I have tried to explain you this sum. I feel that you have followed all these things. Thanks to all.